Hello and welcome to The Rate Stuff, your essential guide to all things mortgage. My name's Jack Izzard.
I'm Peter Stimson.
This is our first show of 2026. Delighted to be back with you. And Peter, we are off to the races. It has been a gallivanting start to the new year. Lots of lenders cutting their rates quite aggressively.
It has, Jack. I mean, you've got lenders out there at the moment lending at or around swap, which is pretty incredible and unfortunately probably not sustainable.
Yes, and Peter has seen some worrying signs in the swap rates. So we'll help you decode what they mean and look at where rates might go next. All that coming up on today's issue of The Rate Stuff. So it has been wacky races time at the start of January for the big lenders. We've seen lenders cutting their rates pretty much across the board. Just before we come on to that, Peter, a quick announcement if those of you are concerned about my nose. You're probably not that concerned, but as you can see, I've got a cut on my nose here. That is not due to some overly heated row about gilt rates with Peter. I mean, you get quite feisty, don't you, when you're talking about 10-year treasuries. But no, it was actually a gym-related injury. So like many people, I joined a gym for the new year and I was lifting a big, heavy barbell over my head and it didn't quite go to plan. Unfortunately, I didn't break my nose, but I did cut my nose in the gym at the weekend and looked a bit of a plonker, if I'm honest.
Well, you know, fitness is dangerous, Jack, as they say.
Well, seemingly that way. Anyway, that was my silly story. That was my looking like a plonker. Hopefully, I'm not going to look too much of a plonker now because I think, Peter, we're on more stable ground talking about interest rates. That's your
fingers crossed
specialist subject. So you mentioned that rates have been coming down across the board. I mean, we've seen the big lenders cutting rates right to the bone. Give us an idea how low they've gone.
They're basically lending out swaps. I mean, if you look at we've got the swap graph going up now. You can see 2 years around about 354, 5 years around about 377, and you've got lenders lending at really where the swap is. It's two reasons really. I think there was kind of an anticipation that swap rates were going down and were going to continue to go down. That hasn't happened. If anything, swaps kind of started to nudge down at the beginning of the year and have actually crept up again. And secondly, it happens every single year. Lenders look at their targets for the year, they get set probably centrally. They look at it and then go, wow, we need to get off to a great start. They all rush out the starting gate, try and get some big numbers on the board. They lend kind of at rates which aren't sustainable longer term, and it gets to sort of, you know, end of February, beginning of March, and they will start putting their margins back up again. So this isn't sustainable for two reasons. Number one, because the swap rate has crept back up again, and number two, because simply they can't, you know, it's a marathon, not a sprint, basically.
Yeah. Okay, goodness me. I don't think it's possible to get any more racing analogies in a sentence than
I can try.
Well, you've given it a good go there, Peter.
Yeah.
Okay, so yes, bit of a January sale. They're all kind of taking lumps out of each other, trying to grab a bit of market share. But yes, unsustainable because that swap rate has ticked up. Now, there's a couple of factors behind that. We had the December inflation data come out, and CPI inflation has risen for the first time in 5 months. It went from 3.2 up to 3.4% in December. We've got wage inflation quite high as well. So all of these things suggest that the Bank of England isn't going to rush to cut the base rate again. So where are you on base rate now?
Base rate now, I mean, there's only one price cut into the swap curve if you're looking at it now. I think we need to make that clear. Some of the stuff I've been reading out there is people going, there's two cuts priced into the curve. It's not, there's just one. My best guess, and it is that really, because it's really going to be dependent on, you know, wage growth, you know, GDP and inflation. If I was a betting man, I would probably somewhere between April and June is my best guess at the moment.
Okay, all right, so one base rate cut to come this year. That, of course, will make big headlines when it happens. But between now and then, we're very much guided by those swaps. And as you say, the swaps are ticking up. That means that we're probably going to see interest rates start to tick up. And then there is an interesting thing going on between 2 and 5, isn't there? If we just bring up that swap rate curve again, they're starting to diverge, aren't they?
Yes, we've got the swap rate graph going up. It's going back right back to when Mr. Trump took power. And we've got three curves in there. We've got the 10-year, we've got the 5-year, and we've got the 2-year. We're showing all three of them because it's basically showing the 10-year blowing right out. The 10 years blowing right out because of obviously the cost of longer term debt. No one really wants to hold longer term debt because obviously the toxicity of longer term debt, given what's going on in the US in particular, and the 2 and the 5 year are starting to diverge. And they're starting to diverge because we're hitting the bottom of the interest rate curve. As you hit the bottom of the interest rate curve, basically the story is there's only one way, and that's back up again. So as we hit probably 3.5% is perceived by the markets to be the bottom. Longer term, as you go out and you're looking longer out towards 5 year, interest rates are probably going to start rising again.
So as we look at this chart now, that's why the 5 year is the middle one there. It's quite a bit higher than the 2 year one.
Yeah, you're looking at about 20 to 25 basis points higher than the 2 year, because obviously 5 year is the weighted average cost of over 5 year period.
Yeah.
So basically it's going up again versus the 2 year, because obviously they view that market rates are starting to rise again over that 5 year period.
Now you're not completely surprised by this divergence, because as we were rehearsing this morning, and by the way we do rehearse this, it isn't completely spontaneous.
Not completely off the cuff.
Yeah, right. Anyway, much as it might seem that we just made it up down the pub, but Peter, yes, you weren't completely surprised by that divergence, and you said to me that that's a classic sign that we are hitting the bottom of the rate curve.
Yes, because at some point, you end up with a longer term, rate rise going up the other way, because obviously, you can see that, as the 5 year and the 2 year kind of meets at the bottom, the 5 year starts rising, simply because the rates can't continue to go down forever. There is a point where they bottom out and the curves start diverging apart.
Okay, well, a very useful explanation from Peter there about why those 2 year and 5 year swap rate curves are starting to separate. But what does it mean in terms of borrowers and brokers? Stay with us as we unpick those tricky conversations that brokers are likely to have in coming months. It is the eternal question that brokers get asked by borrowers and potential customers. 2 year or 5 year fix, which is better? Now, from a customer point of view, at the moment, it seems very clear. 2 year fixes are much cheaper than 5 year fixes. It's quite a big gap between the two, isn't it, in terms of average rates right now, Peter?
It's opening up again. You're looking, in terms of the actual products, 25, maybe even 30 basis points between the two. So when it comes down to monthly payments, 2 year is clearly better, and I look in inverted commas better, because better can mean different things to different people, certainly cheaper.
Now, I'm guessing a lot of customers, when they come to a broker, they just want the cheapest rate, they want that lowest monthly payment. Inevitably they're going to think, well, clearly it's 2 years, that's the only game in town. What sort of conversations do brokers need to have when they get a borrower come through the door like that?
I mean, you're right, a lot of customers are looking at, what's the, my lowest monthly payment I can get, because obviously quite rightly customers are thinking about monthly cost. I mean, the challenge is, and the graph emphasised that, is what happens in 2 years' time, because I think, whilst you may have a lower monthly payment for the first 2 years, it's when you come off that fixed rate in 2 years' time, where is the market likely to be? There are an awful lot of challenges out there in the market, and an awful lot, without wishing to sound like Donald Rumsfeld, a lot of known unknowns out there at the moment. We don't know where interest rates will be in 2 years' time. They may well be, if not the same, potentially higher. The 2 year market is indicating, or the market is indicating that rates could potentially be higher. There's a lot of, geopolitical factors going on out there. Trump will still be in power in 2 years' time, and he'll have a year left. What particularly worries me personally, and at a personal level, is with a year to go, he's going to want to make a mark.
Yes, that's true. So if you look ahead 2 years, he'll be in the final year of his supposedly final term as president.
Yes.
Hold that thought. He
Yes.
might go for a third against the Constitution. But anyway, we'll see. So, yes, I mean, who knows what he'll do. I mean, if he wants to kind of go out in a blaze of glory, he could start doing crazy things, and that would inject loads of volatility into the global financial system. So who knows where rates might be then.
I mean, we've had just over a year, and you've seen the volatility that's gone on in the market with Venezuela, Greenland, tariffs, and this is just the start.
Yeah, and we saw gold prices hit $5,000 an ounce at the end of January. I mean, that's again an indicator of just how anxious the markets are about risk.
Yeah, he's looking to the Department of Justice. Obviously, couldn't have anything to say that he's got anything to do with that. He's looking to prosecute Jerome Powell, the head of the Fed, at the moment. So God knows what goes on at the Fed in the next couple of years, and whether the Fed maintains some degree of independence. So there's all these factors that could push through into, interest rates in the UK. So stability is worth thinking about, I would say, to any broker if you're looking between 2 and 5 year, and if you can get a 5 year at sub 4%, that's well worth thinking about, I would suggest. Obviously, I'm not in the business of recommending, because obviously that's not my job. I'm not sitting down in front of your client. I don't know your client's circumstances, but given where we are, that's something to bear in mind.
Okay, caveat duly noted. So look, that's the question about cheapest rate versus longer term stability. So I see that argument.
Yeah.
What about this one though? A lot of borrowers, and myself included, will have muscle memory.
Yep.
Every mortgage they've ever had, or most of them perhaps,
Yes.
Were 2%. They think that's normal.
Yep.
There was a time, of course, before 2010 when that wasn't normal at all.
No.
And a lot of people just don't know that. And they will probably be thinking, wow, 3.5% now, I'll fix for 2 years.
Oh, yeah.
It'll go down to normal levels in 2 years' time.
I totally get that. I mean, I imagine that probably a good, almost half of borrowers out there, their memory of mortgages is having a rate sub 2%.
Yeah.
I totally get that. I mean, my memory of mortgages is having rates. I mean, my first mortgage rate, given I'm old, was 7.5%.
Wow.
Yeah, I know. Wow.
Was that in sort of pounds and shillings and pence?
It was in guineas, actually, Jack.
Okay.
But
don't laugh. We might be going back to the gold standard.
we may be going. Yeah, the way things are going could be the way the US dollar's going could be gold standard.
Yeah.
So I think a normal rate, anything sub 4, is pretty decent in the scheme of things. I personally don't see it going back that way. But like I say, given the instability, things are possible. I just don't think it's very likely.
Okay, right. So yes, that is a tricky conversation the broker's going to have, because
Yes.
there will be this sort of inbuilt sense amongst borrowers that, well, rates are high now, they'll go back to their normal levels soon, so why would I fix for 5 years when the only way is down? So if a client has that point of view,
But
how best for the broker to just explain
it's taking
about
back
this
to, I think it's always taking them back to 2022 and think what happened in 2022.
Yeah.
People who had a 5-year fix in 2022 rode the interest rate wave the other way when rates went up to 5%. They're coming out now when rates have kind of gone back down the other side. Okay, they fixed sub 2 and they're coming back into a market where the rates are sort of 3.75, 3.8, 3.9 on a 5 year. So okay, they're fixing at a high rate, but they've gone through this period of massive instability and they've kind of weathered that storm. So the benefit of taking a 5 year versus a 2 year is where you have periods of instability, it gives you that kind of window to sort of weather the storm and kind of have that longer fixed period.
Yeah.
So
yeah, no, I think that's a useful marker to use, actually, because I hate to admit it, but most borrowers probably don't follow Donald Trump in quite the same level of detail you do, and Jerome Powell and 10-year treasuries and all the rest of it, but they will remember the trust mini budget and the chaos that follows that, with rates spiking past 5%. So if there is a conversation to be had about attitude to risk and do you want to fix for longer, that's a good thing to bring up, isn't it?
Yes, there you go. And don't forget, we'll have another election. A 5 year will take you past the next UK election as well.
Okay, well,
bear in mind.
Yes, well, given what's happening there, who knows? So yes, a rocky road ahead, but look, a good start to the year. There is certainly some latent demand there. We've seen a lot of mortgages being written. We've got a lot of people keen to buy now because property prices have settled a little bit. Affordability is better than it has been for some time. So there is demand there, but that question, 2 versus 5, is always going to be the one on a lot of borrowers' lips and a lot of brokers too.
Absolutely.
Okay, thank you very much for joining us today on The Rate Stuff, and thank you, Peter, for decoding what those diverging swap rates mean. And do join us next time for another issue of The Rate Stuff.